Power Lunch. Let's get into some strategic thinking, as always on a Monday. In the Power Lunch Cape Town studio with me is Michael Power, strategist at Investec Asset Management, sometimes in Cape Town. He travels maybe 5-6 months a year, and in the past has travelled quite extensively to China. China's in focus this afternoon because the GDP data for the second quarter has come out in line with expectations, but I think 9 out of 10 months now we've had a declining GDP. We came in at 7.5% year on year in the second quarter. Shock horror, Michael.
No,
the last time that we had this was 1990. It's all over, surely.
All over? No, not at all. I mean, we're talking about an $8 trillion economy now growing at a nominal rate of, in US dollars, about 12.5% per annum, not 7.5% in real renminbi. For us as a commodity exporter, it's far more important to understand what's happening to the size of the demand pool. And we're facing a demand pool that's still growing at over 10% per annum. Admittedly, it's slowed down fairly dramatically from where it was, but it's still growing at a solid rate. That said, what people have been saying for the last 5 years is that China shouldn't be growing this fast. And the NDRC and the Chinese government, the Li and Xi show, believe that too. That's why they have purposely been slowing down the economy. It probably had a few speed wobbles over the last couple of years. They are changing the shape of the economy. They're making it more consumer rich. Incidentally, did you see actually that the retail sales number was actually not substantially, but significantly higher than forecast?
13.3% versus the forecast of 12.9%. It's massive.
It's significant. It's significant. And what we're seeing now is the changing shape of the Chinese economy and the changing shape of the Chinese growth model. And we're still so stuck in the old model that it's actually very difficult for us to make the adjustment.
Why shouldn't it grow so quickly? And why do they want to slow it down? Because if there's no inflation in the system, and at the moment there's been a couple of spikes when commodity prices went through the roof and we had pork prices going up and there was talk of civil unrest because of these things that we don't understand in the West. But why shouldn't it grow at 8-9%?
Well, I think they realised that the sort of growth they were generating had some complications to it. Pollution complications. It was a very debt-rich, as we know, growth rate, and they wanted to see something that was a little slower, but by being slower, more sustainable. And that's exactly what I think they're trying to engineer at the moment. I still think there's going to be a few bumps along the way. It's a relatively young economy, and it's still not so easy to fly this economy. But nevertheless, I think thus far they've proved they can, and if they are going to change the economy and make it more consumer rich, more service rich, less investment driven, less manufacturing oriented, then I think they seem to be going about it the right way at the moment.
Let me have a quick look at this. It says here, biggest fib of the year. I'm just reading off my tablet here. Biggest fib of the year. China GDP grows 7.5% in second quarter. This comes from Forbes.com. It says moments ago, Beijing's National Bureau of Statistics, etc., etc. They say that it should be much lower than 7.5%. What do you say to that?
What do you mean by should? That it's a good idea if it would be, or
no, it means
the
that
statistics
they've
are wrong?
Misquoted the statistics, or they have massaged the statistics.
I don't know that. I know that we've seen lots of massaging of statistics all over the world, including in the United States. Their inflation figures are notoriously bad after the fact. I think it's probably there or thereabouts. But as I say, I don't look at real figures in RMB. I look at nominal figures in US dollars. And in that respect, yes, it's slowing down fairly dramatically. Actually, last year, China grew in nominal US dollars at 24%. This year, it'll grow at about 12.5%. That's a big slowdown.
In nominal US dollars.
In
What's
nominal
the
US
significance
dollars.
of that? I mean,
Well, that's what we sell into.
Why can't we put it in yuan, though, or renminbi, whichever you want to call it?
We can do it in that if you wish, but we as South Africans don't sell into that pool. We sell into a dollar pool, and that's we monitor how fast that dollar pool has risen. That dollar pool was about $1 trillion in 2000. It's about $8 trillion now, and it's rising by some 900 billion every year. That's the size of the economy. The Chinese economy today is growing roughly at the same size as it was in totality in 2000.
One of the reasons why that Forbes article to me was interesting was because they said that one of the months that is contained in the quarterly figures that we saw today, i.e. 7.5% growth year on year, was a month before the invoicing so-called scandal broke out. So they say that it should be maybe down at maybe 6.7, 6.8. What do you say to that?
That's possible, absolutely possible. I think that where China's growth in real renminbi is heading is towards the 6.5%, 7%. which I think is far more sustainable longer term. You don't want to have a situation whereby only one day in January this year was actually declared non-dangerous in terms of pollution in Beijing. There is a definite attempt by the two new guys in town, Li and Xi, to change the model. Yes, they're still thinking about the so-called 5 harmonies, but they want a very different sort of China to emerge in the next 10 years, the so-called China Dream. And the China Dream is really what they've staked their reputations on achieving.
Talking about the China Dream, the Shanghai Free Trade Zone has been debated quite extensively. Is it a reality, do you think, and is it going to be meaningful for the long term for the growth of the Chinese economy? Can it be replicated throughout China?
Ultimately, probably yes. I don't think it's a reality yet. I think the idea is an extension of the special economic zones, but to a higher level. And I think it's something which is very interesting to watch. I would question to what degree it might actually start putting pressure on something like Hong Kong.
And also pressure on the Chinese financial system, because I think the fact that it's Shanghai means that there will be a more open attitude towards foreigners participating in markets in China. That could be quite dangerous, I would have thought.
That's precisely where they want to travel. If you listen to especially Li Qiang, the new Prime Minister, he is very much in favour of seeing much more role played by the free market in determining of prices than has been the case in the past.
Do you think the Shanghai Composite Index would be just above 2,000 where it is now if foreigners, for example, like our friend Carson Block, who is notoriously anti-Chinese, anti-China growth and anti-China economy at the moment, do you think it would stay where it is, or do you think it would go up or down?
I don't think at the moment. If you look at, they've just changed over the weekend the QFII allocation. I think they've increased it by about 100%. But even before that, it wasn't being fully utilised. So I don't actually think it is going to make any difference for the time being.
Just like the world has become used to quantitative easing from Mr. Bernanke, the world has also become used to 7.5% plus in local currency terms for Chinese growth. So do you think if it does go down to 6.5%, numbers that you've mentioned and other people are mentioning, do you think people will say, goodness me, this is not in our model?
They will, and they need to adjust their model because China is adjusting its model as to how fast it wants to grow and in what way it wants to grow. We can't carry on just assuming that because the world is flying on one engine called China, and if that engine for our purposes in the rest of the world starts to slow down, it's causing us enormous amounts of pain, that actually might not be very good reasons for the Chinese for that engine to slow down to a 6.5% growth rate, which for the Chinese is more sustainable and more integrated and achieves their objectives. I think that they're moving in the right direction. It may not suit our purposes, the way that we look at China, but I mean, is China growing for itself or is it growing for us?
It needs to grow for us though, doesn't it?
We might think so, yes.
South Africa, that is.
Oh, for South Africa, but we're stuck in, truly a dreadful position where we've got no volume growth coming through in our commodity exports. We just wait for the price to rise, and it's like the rain. It falls on us and we feel great. We're not doing anything to increase. We've actually seen our volumes of most of our commodities either flat or fall over the last decade. Gold now down to the 6th largest producer in the world.
Apparently Peru overturned us, usurped us recently.
Indeed. And we're not really investing in the infrastructure to support the increase in the output of our commodities. I mean, the whole scission story is a tragedy. So I think we just wait for the prices to go up. We can't get any volume gearing, and truly volume gearing is the way that you're going to play this next stage of the commodity cycle. Everybody who's hypnotized by prices is going to be severely disappointed.
To summarize, you're still bullish of China, but there will be speed wobbles or bumps on the way.
I think that as it slows down, there'll be a few wobbles because it's moving into new territory and it's untested, and they're going to have to deal with those as and when they arise. It's still got a lot of flexibility in terms of reserve ratios in the banks of 20%, which the rest of the world just doesn't even begin to understand. It's got a lot of foreign exchange reserves. It has a very high savings rate amongst individuals. I do think, though, that some of the pressures that are starting to build, for instance, with regards to wage rates as measured in US dollars in China, are now beginning to make China uncompetitive in low value-added products, and a lot of production is migrating to places like Vietnam, Indonesia and Bangladesh, and even the first signs of it coming to Africa, places like Ethiopia and Kenya.